Let's talk Peloton. It's been a wild ride for the stock, which is down about 6% today after climbing 15% yesterday on a $1 billion stock offering. Peloton now up 8% in the past week. Even with those gains, shares are down 41% over the past 2 weeks and almost 70% off of their 52-week high. But my next guest says the stock has been punished enough. He named Peloton a new fresh pick in a note this morning. With us is Jonathan Komp, an analyst at RW Baird. He has an outperform rating and a $90 price target on the stock. Jonathan, welcome. So why now?
Yeah, great question. Thanks for having me, Kelly. I think to call the downdraft here in the stock stunning would be an understatement. The stock's been cut in half over the last 2 months, and most of that's the last 8 to 9 trading days. And we think that's overdone here, and we think there's a lot of signs that the low 50s could be a bottom on a sustainable basis here for the stock. And yesterday's announcement of a $1 billion equity raise certainly helps that. That removes one near-term overhang in our view. And looking forward over the next several months and quarters, we think that the catalysts here could actually improve relative to the very low expectations here.
Have you been surprised at how poorly Peloton has traded this year?
Yeah, there's a lot of factors at play. I think it's always difficult to separate the short-term trading from the longer-term prospects. If you step back and look at the long-term prospects, both for Peloton and the connected fitness and at-home fitness industry, we think the prospects are brighter than ever. If you look since COVID, the adoption rate at home has accelerated. We still think there's potentially as many as 70 million households in the U.S. alone that would consider a connected fitness device. And there's tens of millions of bikes and treadmills that are installed in houses in the U.S. alone today. So we think the opportunity is as bright as ever. Certainly there's been a pull forward of demand and sort of a plateauing or flattening this year against some pretty tough COVID-driven comparisons. But looking beyond the next few years, we think that the outlook is very bright. So even though there's a lot of volatility in the short term, we don't think that should detract from the long-term opportunity.
You know, people were scratching their heads yesterday because usually you do a secondary, especially one under a little bit of pressure, and the shares tank, and instead they rallied. So one analyst I saw was saying, well, maybe they need to announce some M&A pretty quickly that would validate the shares' performance yesterday. Would you like to see them go that route?
Yeah, that's not necessarily our view at this point. I think if you look at what's impacted the stock, concerns about the need for equity and more capital has been one of 3 or 4 different factors. So we think having a balance sheet now with more than $2 billion of cash on hand really helps alleviate some of those short-term questions. Whether or not that goes towards just general purposes or M&A, that'll be seen here going forward. But we think just the base business, the bikes, the new tread they launched, some of the new products, really in its own can drive a lot of the growth that we expect going forward. So M&A would sort of be on top of that, but that's not part of our fundamental thesis.